Riders are tools you should be familiar with. They can benefit clients by modifying the scope of coverage in a policy, but they also usually add to the premium amount. One use of riders might be that of protecting family members without having to purchase separate policies for everyone in the household. For instance, a mother has a whole life insurance policy and wants to insure her family. Buying separate policies would get expensive. Instead, she could add them through a family term insurance rider. This is much less expensive and would provide similar benefits. Another example might be to attach a guaranteed insurability rider to a policy. This provides the ability to purchase more coverage at specific dates and times without the insured having to prove health. This feature can be beneficial if an insured needs more coverage, but their health has declined since the policy was originally purchased. Our next section concentrates on some of the provisions and options found in life insurance. Once again, some of these are required in the policy, but others are optional to the insurer. Beneficiary designations are one of the more important areas of life insurance policies, so make sure to pay close attention. Clients expect you to have thorough knowledge in this area. There are IRS and tax discussions included as well. For example, the IRS's contemplation of death rule applies to those who attempt to give away assets prior to their death in order to avoid estate taxation issues, and it makes it difficult to avoid taxes this way. Important consumer protections will also be examined, like the free look provision. This allows a policy purchaser a period of time to examine the policy and decide whether to keep it or not. If they choose not to keep the policy, the carrier is required to refund any premiums and cancel coverage. There's another type of protection in place for permanent policyholders as well. If a permanent policy lapses because the premium has not been paid, the insurance company cannot declare the cash value forfeited and keep the money. The policy owner will have choices in what to do with the cash value. These are known as non-forfeiture options and can help protect an insured, sometimes even when premiums can't be afforded. Non-forfeiture options can also apply if the cash value policy is intentionally canceled by the owner. Sometimes even if a permanent policy lapses, there's a chance it can be reinstated. Of course, the process would probably include proof of health, but there's a distinct advantage in reinstating a policy compared to applying for a brand new one. We'll also examine policy loans, including the automatic premium loan. Policy loans are only available in permanent policies, and there's an interest rate attached to these loans. They can also affect the policy if the loan isn't repaid. The subject of beneficiaries will be investigated in depth as well, how they're designated, different classes of beneficiaries, and how the payout process works. There are a number of methods for settling the death benefit. Beneficiaries rarely know how settlements work following the insured's death, and at times, you may be asked to guide claimants through the process. Annuity payouts will be examined also. Like life insurance settlements, annuity payouts can be structured in different ways to provide annuitants with choices. Then we'll look at policy dividends. These are completely different from stock dividends and have different tax ramifications, but they're only available on certain kinds of policies and never guaranteed by the insurance company. Finally, we're going to take another look at some common policy exclusions and how insurance companies interpret them, apply them to certain situations, and how they may affect the payment of a death benefit.